I want to thank those that are taking a little bit of time out of their day to join us. Kind of the idea that we had at Lucern was to bring in some of the industry experts that we work with on a regular basis, that provide a valuable insight to us as an operator. And I find that sharing, questions that are being asked around the country throughout the investment world, it's good to, kind of dive into those questions and see what someone that we're working with has to share. So I will get us officially started. Welcome to our second webinar of 3 questions, 20 minutes, and 1 guest. The goal is to make 20 minutes of very useful and helpful information for you. And I'm really excited to have with me today Ron Corrao, who's is a broker, multifamily broker that we've had a relationship with for over 7 years, transacted on hundreds of millions of dollars in real estate, and he oversees the Southeast for his brokerage, and he'll give you a little bit more background about himself, and then we'll dive into our questions. So Ron, why don't you take it away and share a little bit about yourself and your background?
Yeah, absolutely. David, first and foremost, thanks for having me on. It's a real pleasure to connect with you again, talk to some of the investors that are on, and also get a chance to share some of what I'm seeing in the market right now. So, appreciate the introduction. My role, I'm with a firm called Capstone Companies. We're a national multifamily brokerage shop with offices from really across the country, East Coast to West Coast. We're headquartered here in Charlotte, which is where I'm based. I lead our Carolinas and Virginia offices that cover North Carolina, South Carolina, and Virginia. And what we do, as you mentioned, is exclusively multifamily brokerage. About 80–85% of our business is selling existing multifamily assets, A, B, and C class assets, and the other 15-ish% or so is selling land developable for multifamily. So we interact with a lot of developers that are active in the marketplace right now, trying to build new deals, get them out of the ground, certainly work through what are, have recently become challenging times. But, we really work with our clients soup to nuts, both on the, acquisition, disposition side, and then also on the development side too.
Great. Thanks for a little bit of that insight. Ron is an awesome guy, and just feel honored to get to work with him and what he's done for our firm. So a good broker's worth their weight in gold. And Ron, you're a big nugget of gold. So let's jump into the questions here. The first question today is what are the biggest challenges you've seen facing the multifamily industry over this past year?
Well, so that's a great question. I'm glad we're starting here. First and foremost, rates. The velocity of rate hikes over the last really 18 months has been unprecedented, and it has created a lot of challenges and dislocation in the market. Now, there are some opportunities too, but the biggest piece that, in speaking with our clients on both the ownership side and the buying acquisition side, is where are rates today? Where are they going tomorrow? How am I underwriting, and how is my underwriting impacted by interest rates? So I'm sure, Dave, I know you follow this pretty closely. I'm sure many in the audience do as well. With rates having risen and the Fed working their darndest to try to get inflation under control, they have put upward pressure on, U.S. Treasury rates, specifically the 10-year rate, which a lot of multifamily debt is priced off of, whether it's agency financing or bridge debt financing or even bank financing. Rates are really what drive the acquisition criteria for many groups. And as we've seen rates tick up, cap rates have, in a correlated manner, also ticked up. So whereas before we were seeing maybe Class A product in the Charlotte market trading in the low 4 cap range, now because rates have risen and ultimately squeezed returns, buyers are able to pay less in order to generate the same level of returns for their investors. So now what was a low 4 cap for a Class A deal in Charlotte has kind of moved up to a upper 4, low 5 cap range. And that really filters through all asset classes. So you're seeing that with the A's, the B's, and the C's. Some product has been hit a little harder, but the biggest challenge that we're facing right now is rates. So, here's an example. If you're an investor and you have underwritten a deal and you have penciled it and it makes sense at a price, and you've worked with a good broker like myself to come to terms with a seller, and you sign up that LOI, you sign up the purchase and sale agreement, and you're ready to move forward. Well, you've pretty much got about 60 days between when you go under contract and when you will effectively close. What we were seeing earlier in the year with how quickly the Fed was raising rates, they were almost on pace for a rate hike per month with how frequently that they were meeting. So you might have seen rates increase 50 basis points from when you started the process to where you were looking to end. And that can really bust your underwriting assumptions. And ultimately, we have worked through a lot of retrades this year and renegotiations on price, which oftentimes buyers are doing in the spirit of just maintaining their deal profile, maintaining their return profile for their limited partner investors. And had rates not risen so quickly, most groups are fine to close and move forward under their initial terms of their contract. But all of a sudden, when rates move and the deal profile changes, it becomes more difficult to stick at that pricing, and ultimately there tends to be a renegotiation of price.
Great. Well, hopefully there'll be some certainty back in the market over the coming months as things seem to be leveling out, but I guess we'll see. So the next question, do you think that multifamily has changed post-COVID for both owners and tenants? And if so, how?
Yeah, that's another good question. And COVID and the resulting government response and impact on the economy was, hopefully a once in a lifetime event, but it certainly spread its tentacles far and wide. And specifically in the multifamily industry, like you're asking, tenants had a lot of help and subsidies from the government that impacted behavior and really the interaction with owners and property managers. And what we found is when a lot of stimulus money was pumped into the system by the government to help stabilize the economy, to help tenants pay their rent, in many instances, groups or individuals were either out of work or unable to work. So that stimulus money found its way into their pockets and ultimately helped them pay their rent, and then purchases beyond that. With the A-class tenants, we found that there's kind of less of an impact in terms of those individuals. They seem to be more flush with cash per se, more splurges, but ultimately those tenants have always and will and tend to continue to pay their rent. At the B and the C class level, it does seem like there's been an impact of training those tenants to not pay with the same level of frequency as they had previously. And that kind of came from a couple different things. One, a lot of owners were prevented through local ordinances and mandates from evicting non-paying tenants, which is a challenge unto itself. David, I know you and your team across the board owning multifamily assets have kind of run into that same issue, as have literally every owner out there. So that's been difficult. You can see that in how agency lenders, specifically Fannie and Freddie, started to bake in new clauses into their debt that there were more restrictions for getting out non-paying tenants and going through the eviction process. There were higher hurdles to clear to ensure that those individuals who were non-payers were kind of taken care of to some extent, but ultimately not evicted. And even in that same instance, because of the accumulation of non-paying tenants And when there finally was a breakthrough allowing owners in the Carolinas and elsewhere to process evictions and push evictions through the courts, there became such a backlog of eviction cases that were not processed in a timely manner that those tenants who had received subsidy money, paid or chose not to pay, and ultimately became delinquent, they got into the process of, now the court was preventing the timely processing of the eviction because there was so much of a backlog. So your question centered around the tenant and the owner side. I'm touching on the tenant, I'll touch on the owner in a second. But tenants have received a lot of assistance over the past couple of years that now has since come to an end. We're starting to normalize, ultimately, as an industry, we will get back to pre-COVID type processes, but there is a workout period that seems to, unfortunately, negatively impact owners. From the ownership side, one of the biggest things that we saw was, because there was a surplus of money funneled into the system, and tenants were early on in COVID more flush with cash than normally would have, the opportunity to increase rents substantially was available to literally almost every owner, whether you own an A-class deal, a B-class deal, a C-class deal. We started seeing rent increases year over year of 5, 10, up to 15% in some markets. And it really accelerated the growth in value of multifamily assets from 2020 to 2022, because all of a sudden net operating income shot up, cap rates were compressed, there were more players in the market trying to get after some of these excellent returns. And so the mindset of many investors, as you know, historically real estate has been a buy and hold model and get rich slowly, it became, I'm going to get into this deal, I'm going to underwrite it, and my year 4 rents, maybe I'll hit those in year 18, or I'm sorry, in month 18, and investors were able to more quickly move through a traditional real estate cycle, get into deals, get out of deals. So there were two mindset shifts, both on the tenant side and the ownership side.
So kind of back to center, the golden age of multi, where things are kind of going through the roof every month. We can't sustain that. Now we're back to hopefully a sustainable level where business becomes normal again, right?
We're all hoping for a happy medium that is more consistent with historical trends. I think the accelerated growth curve on both ends is not sustainable, to your point. So let's get back to steady Eddie and no more supercharged.
Yeah. So on a positive note, the last question I have is about opportunity, right? There's a lot of capital sitting on the side, a lot of hesitation, but where do you see opportunities coming over the next year? And if you can kind of expand on that, that'd be great.
Yep, another good question. You really teed them up for me here, David. In 2024, I expect there will be less dislocation and less of a gap between what buyers are willing to offer and what sellers are willing to accept. We've seen that gap close over the last, again, 18 to 24 months. The expectation and the projections that I'm reading are there's likely to be a pause on rate hikes in 2024, and towards the end of 2024, potentially rate cuts, which would be welcome news for the industry in general. If that occurs, I expect that there will be more of a meeting of the minds for transaction opportunities, because to the comment you made in your question, there are a number of investors that have significant capital that are sitting on the sidelines that are waiting to see where things shake out. Many of those are institutional investors that, for whatever reason, they can't get their institutional capital and that level of private equity to pencil Class A deals right now. So they are waiting to see where things move. But also we expect those groups to jump back into the waters to try to pick up deals, because at the end of the day, many of the real estate groups and real estate investors that I work with are very transaction driven. They do want to increase the size of their portfolio and create additional efficiencies, and also create capital events for themselves and their investors. So there's always an impetus and a rationale for getting into and out of assets. The biggest challenge that I think that we'll face, and hopefully this breaks a bit of the logjam, is how our short-term bridge loans, 2-year loans, 3-year loans that were put into place in late 2021, early 2022 going to respond. How do groups that are under bridge debt react to pricing declines? Ultimately, are they pressured to move out of the space? Are they pressured to sell their assets because they may not be able to refinance? That will break up, again, like I said, the logjam, create more transaction volume and velocity. And we anticipate 2024, especially the back half of the year, to be more active than 2023 has been.
Well, that's good news, and hopefully that'll be the case. As we look for opportunities ourselves, it's important to stay dialed in and understand all the moving parts. And again, thankful for the relationship we have with you, because you're a great resource to us in understanding some of the the nuances of what's happening in the market, where opportunities lie. And we're bullish that there will be opportunities coming about as some of the certainty comes back into the market, pending any of these global issues that are happening. So I want to thank you very much. I appreciate you hopping on, and I hope to see the rest of you folks on our next episode. And I appreciate you taking time out of your day to join us.
Absolutely. Thanks for having me on, David.
All right. Thank you. Take care.